Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Friday, April 8, 2016. We're looking at a daily chart of the spider, which is the proxy for the S&P 500. And interesting day, what can I say? The market gapped higher and then basically sold off for the most part for the remainder of the day. And as you know, I always like to say, it's not how they trade them during the day, it's how they close them. And they really didn't close them well. But nevertheless, we did end up closing back above the two important levels, the 204.13 and obviously the 203.98. So that being the case, what it does is it takes the whole concept of the pivot top in place, the whole concept of a trend change, and it pushes it out because we basically have to start over. And we're going to see volatility pick up next week for two reasons. Number one, it's options expiration week. That's the first order of business. We generally will see volume pick up during options X. The second reason is, and this is one is more important, which is it's the beginning of earnings season. So on Monday night, I believe, we're going to see Alcoa report. They're always the first ones out of the gate. And then following that, we start to see the other companies report as the week goes on, and then it just gets fast and furious over the next several weeks. Generally, the financials report early on. I don't know exactly when they are. They could even be the middle of next week for all I know. I'm not really sure. We'll take a look over the weekend and we'll talk about it Monday. But that's going to be ultra important because I expect volatility to pick up. And if we can get any kind of increase in volume on the downside when the market's moving down, then you're going to see the market pick up steam on the downside. However, right now, this market is fighting the bullish case. And basically, the bullish case is we had this up move, and we're basically moving sideways. And the more we move sideways, any kind of spark could send us for that final leg higher. That's certainly possible. We'll have to see what happens early next week. But just to show you the intraday activity today, you can see here the market, here's where the day began, right in this zone here. So the market gapped higher, we continued higher, okay, and then we basically put in a doji candle, right? So this we look for these. We look for these trend change candles, and then the market began to sell off. Then it moved sideways, and then it moved lower. And look what happened at the end of the day. The last hour of the day or so, the market was fighting the 204.13. You can see the importance of this level, how we got below it and they were fighting it, and they basically, at the last two candles of the day, you can see where the magic hand came out and pushed the market to close into the moving averages on the 10-minute chart and close above the 204.13, which basically puts everything in flux and leaves us in the weekend or for the weekend with a big question mark at hand. And that's typical of the market, right? It's never going to make it easy. Nothing's easy in the market. Nobody's going to wave a flag and tell you what's going to happen next. We basically have to continue to put the pieces to the puzzle together and figure it out for ourselves, and that's just the way it is. Couple of things I want to make mention of before we move on. We have a lot of things that I want to discuss as it relates to other markets and how they interrelate. One thing is, I'm getting some questions as it relates to, is the market going to make new highs and all this stuff? And I know that's being discussed in the media, and that's good when it's discussed because whenever it is discussed, it's less likely to happen. And whether it happens or not, really, the first order of business is, I don't really care whether it happens or not, and nor should you. Whatever the market does, all we want to do is be able to identify what the correct side of the market is to be on and be on it. That's it. We don't really care if it's going up or going down or going sideways. We want to find profitable trades which whatever way the market is going, it shouldn't matter to you, it shouldn't matter to me, and it doesn't, okay? But that being said, if you remember, the folks that have been around a while certainly remember this. Back in last May, May of 2015, I called for a pivot top in the market, and I suggested at the time that the likely scenario was that it was going to be a long-term annual high, not to be seen again anytime soon. Okay? Now, just to give you a snapshot of where that was, let me go over to a weekly chart. Okay, so that was up in here last May. Okay, it was the week of May 22nd, 2015, and the high was 213.78. All right, so at that time, I said that the market's most likely going to top out, and that was in the first half of last year, and then the second half of last year was going to be the bearish half of the year, and then the market was probably not going to surpass that high for quite some time. And I still believe that to be the case. Can I be wrong? Of course I can be wrong. But in terms of probabilities and how confident I am that that's the case, I'm going to give it an 85, maybe even 90% chance that I'm right on that. Okay, if I'm wrong, I'm wrong. I'll tip my hat, and that's just the way it works. But based on a lot of work that I do, and a lot of different cycle work, a lot of mathematical work, it tells me that that was a yearly high not to be seen again anytime soon. I'm going to stick with that until proven otherwise. So we'll just stay with that. And I wanted to bring that up because I do have a handful of people asking questions about new highs and all this stuff. And I get it. That's fine. And you're more than welcome to ask the questions. I have no problem with it. So I wanted to just, instead of answering individually all the time, I thought I would just throw it out there for a brief 1-minute discussion, kind of give you my thoughts for those that are thinking about it, and now we'll move on from there. So let's move on to the IWM. And the IWM was up slightly more than the spider today. And, you know, as we've been discussing the last couple of days, this is a more bullish pattern, right? We're into a lot of resistance at 110.52, okay, and that did prove to be resistance, but this is a bullish pattern, right? We had an up move, sideways, up move, pullback, wedge pattern. You know, this can certainly go higher. There's nothing saying this can't go higher. And it's all going to depend on what happens next week and how the market interprets the beginning of earnings season. It's not what the earnings are, it's how the market interprets and reacts to what the earnings are, okay? We don't really care what the earnings are. They're half made up anyway. They're, you know, they cook the books, they shift money around, and, you know, in the conference call, they tell you what's going to happen in a year from now. That's all nonsense. But the point is, it's not that. It's how the market reacts to what the number is. And we've all seen it go both ways. We've seen, you know, a stock come in on the number and the market and that stock shoots up for whatever reason. And we've seen a stock come in on the number and the stock sells off for the same number. I mean, so you never know how it's going to work out until after the fact. That's why we don't trade into earnings, right? It's really a more of a crapshoot. It's like a coin toss. So nobody wants to hold a stock into earnings. It's really akin to gambling is what it is. You might be right, and you might kick yourself after the fact, but I will tell you that the time you're wrong and you wake up to a big gap down in the morning that you can't get out of before the market opens, or in the pre-market it's already trading down 20% or whatever it is, you'll be happy that you weren't playing into earnings. So been there, done that, have the bumper sticker and the whole 9 yards, got the t-shirt. You know, there's not a mistake that any of you have made that I haven't made at least twice. That's just the way it works. So everything I tell you is from experience, okay? This is, you know, more than 20 years of experience, more than I care to admit. And all I can say is that I've made every mistake in the book way more than one time. So this is all from experience. It's all from having tire tracks on my back so that hopefully some of you don't have to have them on yours. That's really the goal here. All right, so the IWM, there's really not much to talk about. It was up basically in concert with the spider today. Spider was up 1/3%. IWM was up 0.5%. But all in all, if you look at the intraday, you can see here the IWM gapped up the same as the spider. You see the sell-off. Chart pattern intraday looks very close to the same. And look what happened. So this final big down red bar here, okay? You can see where the market tried to rally up, couldn't close above that red bar high, and then sold off. So that was basically a line in the sand intraday. If the market closed a 10-minute candle above the high of that candle, 109.36, then you most likely would have seen higher prices and it traded at least into the 200-period moving average at 109.60. But you see, whether it's the 10-minute chart, the 60-minute chart, the daily chart, the weekly chart, they all trade the same way. the patterns that I identify for you guys, it's all the same. It doesn't matter what time frame we're talking about. A chart is a chart is a chart, whether we're talking about the dollar, gold, crude oil, the spider, IWM, a stock, Apple, Chevron, Exxon. It makes no difference whatsoever. They all react the same way. All chart patterns or all charts trade the same way as it relates to the patterns. So we can't really take too much out of this. We're going to have to wait for earnings season to begin. It's going to be options expiration next week. We should see a pickup in volatility, and we should get a definitive answer on which way this market's ultimately going to go. And by the way, you should probably write this down. Wednesday, I show Wednesday next week as having probably the most volatility of the week. I can't tell you if it's going to be an up day or a down day yet, but what I can tell you is that it's generally going to be a larger swinging day, meaning you're going to have most likely a wider range day on Wednesday than any other day next week. So just jot that down, keep it in the back of your mind. It's good information to just notate, right? We just want to be aware of it. Okay, so here are a couple other things I want to discuss as it relates to the market. So when we look around the globe and we see different markets, the European markets, the Asian markets, and we see, in particular, what is going on around the world and what information can we glean from other markets and how they're reacting. Because truth be told, the U.S. Central Bank, the Federal Reserve, and the European Central Bank, the ECB, and the Japanese Central Bank, the Bank of Japan, basically are all in concert together. They're all adding liquidity or doing, not necessarily all at the same time, but it's all a concerted effort to liquefy, if you will, and keep buoyant the markets around the world. So it's basically, a global market, okay? So let's take a look and just look from a longer term perspective. First, let's take a look at a weekly chart of the spider, okay? Just to get a snapshot of what we're looking at, we'll use this as the benchmark, okay? So you can see here, the spider had one heck of a bounce off the February lows. Okay, January low, February low, and now we're coming into that downsloping trend line, but we're basically only a few percentage points off the high. So the market's been acting great the last couple of months, okay? So the market's, basically in a good position. If you just woke up today out of a 2-year sleep and said, "Where's the market?" and you took a look at this and said, "Oh, it's near an all-time high." That's fine. So now let's look at Japan, and we'll use the EWJ is the ETF for Japan. It's good enough. Okay, and look at this. Same chart, weekly chart. Okay, does it look the same? We have highs, lower high, lower high, lower high. So I find that interesting. We're nowhere near the same level where we were at the highs last May when all the markets were at highs, right? This is the same month of May that the S&P was making its high, okay? And the Japanese market is basically nowhere near the same level since the recovery in January, February, right? This is the same February low, okay? And this is a very, very mediocre bounce. It's basically in no way, shape, or form anything other than a bear market bounce, okay? So Japan's weak. So that's telling us something. It's important information. I want to know what's going on globally. This is good information. Let's look at one specific European market in particular. We'll look at Germany. That's the most important European market. What do we have here? Okay, here the European market topped out in 2014 in June. Okay, here is the April high. Okay, and here's the May high. Okay, over here. So it was a lower high even in May of 2015. So we had a high in 2014, a lower high in 2015. A lower high here in the end of 2015, and another lower high so far in April of 2016, okay? So, this looks very much like Japan. So Europe's weak, Japan's weak, okay? The U.S. is kind of the last man standing, all right? Just as a general rule or a rule of thumb, we'll look at the most important bank in Europe, which is Deutsche Bank, okay? It's kind of like looking at J.P. Morgan here. Well, what's going on with Deutsche Bank? Anything good here? Okay, what is this telling you if the most important bank in Europe is struggling? If the most important bank in Europe is below all the moving averages and headed lower, right? It can't really catch a rally whatsoever. This is a perpetual downtrend, And even if we pull back the curtain a little more and look at a monthly chart, look what's going on here. I mean, anything good here to speak of? You want to compare this to, let's go back to the weekly chart, okay? And let's compare this to JP Morgan, all right? Now, JP Morgan on a weekly chart is a very bearish pattern, I might add, by the way. Okay, but it certainly doesn't look like Deutsche Bank, okay? It's still, not that far away from, not necessarily the highs, but a high level, right? It's not acting terrible in the big scheme of things, but what I can tell you is that this down move here and this sideways move, what do you think's going to happen next, okay? Right. Where did this week start to go? This week started that down move, maybe, right? We'll see, okay? This is a bearish pattern, no two ways about it, okay? Down move, bearish wedge pattern. Next move is what? Down. And by the way, I will make mention, and I like to make sure that you understand this. The fact that JP Morgan consolidated for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I think that was 13 weeks unless I miscounted. But basically, we'll call it 3 months. It consolidated above the 200 period moving average on a weekly chart for 2 months. Okay, that 200 period moving average is not going to be as important as it would otherwise be, like when it got a bounce here and when it got a bounce back here and here. Okay, the more times you hit it, the weaker it becomes. The longer you consolidate above it, the weaker it becomes. So on the next move down, if this market has any downward momentum on volume, don't look for JP Morgan to be supported at 55 around the 200 period moving average. It goes lower. Okay, so I just wanted to make sure we're aware of that. So back to the bigger picture in the financials. So we have Japan is weak. We have Europe weak. We have the most important country in Europe financially, meaning Germany, is weak. Okay, we have the most important bank in Europe, Deutsche Bank, is weak. And now let's flip over to something else. Let me go back to the daily chart. Okay, and let's look at the broker-dealer index. All right. So the broker-dealer index is not necessarily, it hasn't sold me on a down move yet coming on the daily chart. Okay, this is an up move. This is still a pullback pattern. And if you look at this from a Fibonacci perspective, we're still in the zone of a 50% pullback, right? 382 pullback. Here's a 50 at 150. Okay, so this isn't terrible. There's nothing going. There's nothing that says this can't have one more move higher. Okay, but we're nowhere near the highs. I mean, if you look at the weekly chart, okay, it looks much the same as we just discussed with Japan and Germany and Deutsche Bank and the like. You have a high, lower high, lower high. Okay, that's not good. This is a bear market. Okay, so from a weekly chart perspective, this is in a weak, downtrending market. All right, that's what this is. Okay, below the 50 moving average, below the 20 period moving average, coming in close to the 200 period moving average again. Okay, you already cut through it, bounced only into the 20. Next time you come into the 50, don't look for a bounce. All right, so there's a lot going on as it relates to the global markets and the financials. And let's take a look at a couple of other financials. Here's Goldman Sachs, okay, weekly chart of Goldman Sachs, the second most important financial, right? High, lower high, okay, down move. What is this? Bearish pattern. Couldn't even make it to the convergence of the 50 and the 200 period moving average on a weekly basis. Where's this going? Well, the next move is likely down, right? That's the way it works, okay? Wells Fargo, okay, another important financial. All right, what does this look on a weekly chart? So the reason I want to bring up the weekly charts is because I want to give you a longer-term perspective of what's really unfolding. We cut out the noise from the daily charts, and we look at the weekly sometime, and we say, you know what? Forget the daily up moves, down moves, up moves, down moves. When you look at the weekly chart, it really, really magnifies what's going on. High, lower high, lower high. Okay, down move, sideways. What's happening? Okay, what is happening here, folks? If the financials break down, all right, and the global markets break down, okay, what do you think happens to the S&P? It breaks down. Now, I'm not suggesting it's going to break down Monday. I'm just telling you the things I look at that factor in to my longer term vision and view and analysis of what's going on. And we're looking for a rollover in the market. It's the bulls fighting the bears. We keep getting above important levels. And I know it's frustrating for some people that are looking for downside. I'm looking at the bigger picture, and I'm telling you that you have to have patience, okay? The market was always due to turn last week in March, beginning of April, first week of April. It may have turned the first week of April. Maybe it starts next week. It doesn't really matter. All I know is the market is due to have a down leg. And I'm not telling you that because I'm hoping for a down leg. I'm telling you that because you need to be careful. If you're long stuff and you're long stocks and you have investments and you have a 401k or anything else that you have, exposure to mutual funds or stocks on the long side, you need to be aware because the likely scenario is at some point in the near term, the sentiment is going to drastically shift. And we may have a blow off top before that happens, up to the 208 level in the spider. It's possible. It absolutely is possible. But that's a 1-2 day event, folks. We're not that far off, right? I mean, it could be Monday, Tuesday, and then Wednesday we roll over. Who knows? I don't know exactly what's going to happen. I don't know what's going to happen Monday. I don't know what's going to happen Tuesday. What I do know about Wednesday is it should be a volatile day. It should be a wide-ranging day. That's another story in itself, but just keep that in the back of your mind. But I wanted to bring up the financials and have us just understand, and here's the weekly chart on the broker-dealers, right? So we look at the broker-dealers, and we have a high, a lower high, another lower high. And if I talked about this a few minutes ago, I apologize. I just don't remember doing it. But this is ominous. This is downtrend, right? They all look the same. So we need to be aware of what's going on and just, kind of take heed in looking at it from a longer term perspective. I think it's important. All right, I think I exhausted the financials and those other markets a little bit. So transports were strong today, okay? So transports were strong. And here, we'll stay on the weekly for a second. And, when you look at a weekly chart, okay, if you look at a weekly chart, this is still, not necessarily in trouble yet until you close below this low on a weekly basis, right? Until you close down there on a weekly basis, there's still the chance that this is an up move, wedge pullback pattern for another up move higher, okay? But there's a ton of resistance. Look at all this resistance. How many weeks did the market spend oscillating around 8,200? 1, 2, 3, 4, 5, 6, 7, 8, 8.5 weeks, let's say. And then back in here, 1, 2, 3, 4, 5, 6, 7, 8. Okay, so from July of 2015, okay, we just have tons of weeks. Okay, we have 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8. We have 16 weeks from July of 2015 that the market spent oscillating around 8,200. You think that level's important? I do. Yeah. You think it's going to get through there so fast? I don't. Not really. Okay? So, by the way, that's not rocket science. What I just did there, I do this each and every day, right? I take a look at the longer term charts, and I look at stuff like that, and I look at stuff like this, and I say, well, if it's spent 2 months at this level here, and another 2 months at this level here, and a month or 5 weeks at the 77.65, I know those levels are important. When they coincide with mathematical calculations, Fibonacci retracements, all that kind of stuff, this is where you begin to put the pieces of the puzzle together. So hopefully, this is helpful. I meant it to be helpful, obviously. Okay, so transports were strong today, up 83 points. So transports, look at this 60-minute chart. This is poised for an up move on Monday. Okay, so you have an up move, right? And you have the pullback pattern, all right? So this is into the 20-period moving average, poised for an up move Monday. It breaks down. If it breaks down, that's fine. But that's what the probabilities say for Monday. If you had to pick a way, the highest probability scenario is for an up move on Monday in the transports early on, right? Okay. So let's move on. We'll talk about gold a little bit. Not a lot happening in gold today. 10-point range. We did get above and stay above, closing above the 20-period moving average, but you still have to close above 1249.80 for any upside momentum to take hold. Until and unless that happens, this is in a shorter-term bearish pattern, right? Here, sideways, right? That generally plays out like this. Okay, but if you close above that level, 1249.80, okay, all bets are off on the downside. And whoop, I didn't mean to do that. Hold on. Close above that level, all bets are off. Something else is going on the upside, and we're not going to see the down move. I'm still interested to buy down here, here, or here. Okay, and if we don't get it, then we're looking for some other reason to buy, and we'll pick a pattern out when we see it and go from there. Silver. Silver looks very similar in the recent, gold charts as compared to the gold chart, but silver is actually looking weaker than gold right now. You have this down move, sideways, down move, another wedge pattern. So it's really a big down move, and we're really just going sideways. I think this is going, down one more time. That's just my opinion. I don't have any definitive information as to why that would happen and when that would happen, but nevertheless, it just looks to me like it's got one more leg down. So does gold. If I'm wrong, that's fine. I'm not long or short either way. I'm just telling you my opinion based on what I see in the chart. Let's move on to crude oil, which was screaming to the upside today. And remember, let's recap, right? We were short gold. We were short crude oil from here. Okay, that's where we went short. All right, it was in the April contract at a different number, but this is the same day we went short. Okay, and what happened was as we got into this area down at 35 and a quarter, above that I said you're going to have to close below 35 and a quarter in order for us to see lower prices like 32, give or take, in crude. And until and unless that happens, it's most likely going to bounce off this level. And if it does, there's a possibility that this was just a pullback pattern in a larger pattern completing to the upside. So this could be an A, B, C pattern. We don't know yet, but I'm just telling you the possibilities, okay? And as far as today's action goes, this was a big move that closed above the 20-period moving average. And, a large up move like this will generally spell higher prices. However, there's always a however. There's always a however. However, we're into a lot of resistance right here, okay? There's a lot of resistance in this general zone, okay? And what do I mean by that? Just the same as we talked about the transports, okay? Crude oil spent a lot of time in and around these numbers here, this number here, right? In this zone, a lot of time there as it relates to the daily chart, okay? And then it did lesser amount of time, but it was, consolidated here to a lesser extent. Now we're into that level one more time, okay? The likelihood of us continuing up early next week, in my opinion, is less likely, okay? My opinion is that the market is going to pull back and possibly come back in to retest the 35 and a quarter. And if it breaks through, then we go down lower to 32. And if it holds, then we could see another up move. But I don't think this move that started on the 5th of April continues into early next week. I think this may have been the final day, or maybe there's one more up day Monday. But I think I'm looking for a reversal back down to test this 35 and a quarter area in crude oil. I have some cycle work that tells me we're coming into a short-term cycle in crude, and therefore, that being the case, that cycle is due to hit on Monday. And since we've had a pretty good up move for the last few days, generally, that being the case, the cycle would turn crude oil down. And that's the main reason why I'm saying this, in addition to the resistance point we're into now. And so you couple those things together and, 2 or 3 guys tell you you're drunk, go sit down. I just don't see a lot of upside from here in crude. And if I'm wrong, but I don't think so. This is the way I read it. We'll have to see what happens Monday. And Monday we'll find out if I was wrong or not. Monday, Tuesday. We'll talk about it again Monday. All right, so let's go over to the bond market. Bond market had a slight pullback today, but nothing changed from the last several days. This is in an uptrend. This is forming a channel to the upside. This is, nothing is different. Above all the moving averages, up sloping. All the moving averages are pointing up. We don't, basically there's nothing wrong with bonds, okay? Until and unless we see some kind of a significant decline in bonds, I'm going to say that we should see more upside based on the pattern that's developing, based on the trend, based on the fact that we got above the 165.10, stayed there, and as longer we trade above 165.10, the more likely we are going to see, what's this high? 167.14. That's going to be your next area that we need to close above. Let's put that in, 167.14. Let me change that to a 4. And that's going to be the next important level in the 30-year Treasury bond. Okay, so we'll just see what happens. If we can close above that level, then we're going to see potentially significantly higher prices in the 30-year Treasury bond. So we're watching, but there's really no change over the last several days. So let's move on. The dollar was down slightly today, and you can see here it looks to be that this bearish pattern, this really was a flag pattern down here, is playing out to the downside, and we'll see. I don't see a lot of downside potential, but nevertheless, we'll have to play it one day at a time, and if something changes and I do see a lot more downside potential, I'll certainly bring it up here, but I just don't see it at this point in time. It's not really scaring me out. We have this level down here that we tested already, and if this level breaks, then I'm going to begin to look at it a little more closely. But you have a lot, look at all this support down here. I mean, the odds on breaking this level are probably 25% in my opinion. So we'll see, okay? Been here before, was supported a number of times. If it does break this level, then back to the drawing board, and we'll have to come up with some additional support levels, which I will do. But for now, I don't see that happening, and that's the stance I'm going to take for now. Okay, so SCO position as it relates to crude oil, I'm out of that on the second half. The first half was out a long time ago, much higher prices. But in terms of the second half, stopped out, flattened SCO. But I may just jump back in on Monday. We'll see what happens. And if I do, I'll let you know on Monday, and we'll take it from there. Las Vegas Sands had a nice little down move today. This is the weekly chart. You can see this kind of trying to roll over here, but it came into the 50-period moving average this week and bounced off of it. But this is struggling. We need to close below the low of this day, 48.57. 48.57 is also the 50-period moving average, roughly. We need to close below that level for us to see any more significant downside in Las Vegas Sands. Other than that, TZA was down a little bit today with the IWM being up, but we're still, kind of close in that. We're really, we're not really underwater that much in that. So we're in at 45. It's 44.54. So it's still almost, it's close enough to a push so far. With that, it's a longer video tonight. I'm gonna leave it there. But I had a request to talk a little bit more in depth about the financials, so I took that route from Mr. David. And that was my pleasure. I take any requests, and if it's something that's relevant and I think is important for the rest of the crew to hear about, I'm certainly amenable to doing it. And that being the case, I'm going to wrap it here tonight. Have a great weekend. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.